Okay, we're looking through the drips tonight, and a name of interest that we're going to take a look at is Coinbase. Coinbase has certainly been in the news a lot because of their linkage to crypto, which has seen some pretty decent volatility. Let's take a look. So Miiflo says that we're looking at a double diagonal trade. Now, double diagonal trade is actually a combination of two types of trades. It's a straddle, which is selling a straddle and buying a straddle. We're going to walk through those. They may sound like funny names you never heard before, but essentially, you don't have to pick a direction in markets to make money. Sometimes the relationships between different expirations of option contracts provide pockets of P&L that we can leverage as we're looking at specific stocks that aren't really going in a direction. Coinbase has been identified as one of those. We'll take a look at the chart just to see, validate what Miiflo is showing. And then we're going to go build the trade. And I think you're going to really like this in terms of the amount of capital laid out versus how to manage the trade, or what the trade is going to look like and what the potential reward is. So we're looking for a double diagonal that is selling one straddle and buying one straddle at differing expiration dates. We're going to look 15 to 25 days in the future on the first ones, and then we're going to go out beyond that up to 60 days, depending on what we want to do. And then we'll see what we're looking to do. Essentially, we'll know that we're right because we're going to continue to trade in a tight range for the next couple of weeks. And that's going to actually turn what's going to be initially a debit trade into a credit. This idea is valid until Thursday, May 26th at 2:40 p.m. Mountain. Let's go take a look now at Thinkorswim. We're going to do this in Thinkorswim. So here's Coinbase. We're looking at a 4-hour chart, and over 90 days, you can see that there's a lot of inventory. These is trades executed at price right around that 66.26 area. And so we spent a fair bit of time here. We've just come through earnings. That's what this spike in implied volatility is, meaning that the product was expecting a lot of movement, and now it's expecting less movement, but it's still relatively high. And so we're going to build this trade as a double diagonal. So we're going to go to the option chain, and we're going to go out 23 days into the future. And the last traded price was 67. We have a 67 strike here. We don't have one in a further expiration. So we're actually going to do the 65s, and this makes sense here in a second. We're going to sell this straddle. So the 65, we could do the 70 as well. That's the other next strike, but 23 days out, we're going to sell it. Now, that's a $16.25 credit. So if we notice, that would take $3,343 to put on with a profit of $16.25 if we stay smack dab in the middle between $48.75 and $81.25 over the next 23 days. Okay, but pretty expensive trade. We can actually increase our probability by just going out a little bit further. So we're going to go out one more week. And here's that 65. And this one we are going to buy. So we're going to buy this straddle. Now notice now that rather than a credit, we're looking at a debit. And it's a debit of $1.75. So this means now that this trade costs us $177.60 to put on. Now, it doesn't show us our max loss or profit because it's hard for that to compute over two expirations. So what we're going to instead do is just keep in mind over the next 23 days, we've got $1.75. We're going to analyze this trade. So we're going to go to the Analyze tab here, and this is what the P&L graph looks like. So here's the current price right now. This is tilted a little bit, right? Because we're pricing this around 65. If we were pricing it at 70, it would be a little bit over here. This purple line is the theoretical P&L. This blue line is the P&L at the expiration of the straddle that we sold. Okay, so what you'll see is if we go out in time, every day that we go out in time and stay inside of this range, basically stay inside of 77.41, stay above 55.16, you'll see that our P&L is going to increase up to the point that we get to June 18, and we would see a max profit of $685.98 if we're at $65 on the 18th. Not likely that we'll be there, but a pretty good chance that we're going to be somewhere in this range where we're looking to make about $200 on our $175 investment. So we can double 100% return on capital on this trade over the next number of days. So very, very Nice trade. Now, if we get outside of 55 to 77, then we'll need to likely exit the trade, but it's not going to, especially if we're before that expiration, significantly go against us. We would actually be at break even here. Down here, we would only lose $100 out of the 177 that we put up, down to that, maximum 177 up to the 18th. Now, after that, it can be more than that, but until then, that's the window that we're looking to do. So, double dispersion trade in Coinbase on Miiflo. Dispersion trades are great. They are great when you find a stock that is really struggling to find direction. It's hard to find those. Miiflo looks through 4,000 stocks, finds stocks like Coinbase that are in this specific thing, and does the work for you. Builds a trade, lets you rock and roll. So I'm going to go ahead and place this trade to work in the morning. So it's $1.75 to $2.80. I'm actually going to work this around $1.95, and we're going to do that. Good till cancel. That'll be good for tomorrow. And that is now working. And I'll see if I get filled tomorrow. And then I'll be looking to manage that over the next 20 days in Coinbase. So double diagonal trade, dispersion trade in Coinbase on Miiflo.